Patience is paramount as an investor. Sometimes you have to hold and weather the storms of the market. For over 18 months, S&P 500 has been a bullet train. After one of the fastest declines of at least 30% in the index's long history, it has astoundingly doubled in value, with growth stocks increasing their movement higher. This isn't true for all high-growth companies that have been surging up with the overall broad market. You can find many suitable businesses that are trading at significant discounts to their own 52-week highs, which are offering a continual up for those investors that exercise patience. There are 5 discounted growth stocks that all have the strength to turn $200,000 into $1 million or more by the year 2030. Here are 5 stocks that are likely to boom over the next decade. 1. Pinterest. Pinterest was down 44% from the 52-week high it had. This social media contender has been pummeled since late July, which is about the time the company declared a sequential quarterly reversal of its MAU, monthly active user growth. Pinterest had 454 million MAUs in total, which was down from the 478 million MAUs in Q1. If you draw your attention to Pinterest's historic MAU growth over the last 3 or more years, there's a noticeable pattern that a single quarter fluctuation isn't changing the company's growth trajectory. What is most pressing to spot is Pinterest's relatively slower growth in Q2 hasn't discouraged advertisers from reaching these users. ARPU, or average revenue per user, sprung up by 89% globally at the end of Q2 in June, showing 163% ARPU growth recognized internationally. International ARPU has the possibility of doubling multiple times this current decade, which should be able to sustain Pinterest with double-digit sales growth end-to-end during the decade. Often overlooked is Pinterest's user base, which can be zeroed in on with amazing results more than any other social media platform. The mechanics of Pinterest make users willing to share the interests, places, and services that are attractive to them. Pinterest only needs to maintain its MAU engagement and provide an interface for users and merchants with supply and demand, specializing in the things that appeal to them. This method of targeting users directly and individually should endow Pinterest with phenomenal power in ad pricing. Number 2. Jushi Holdings. Down 53% from the 52-week blaze up within the cannabis zone, Jushi Holdings is a small-cap US MSO, multi-state operator that possesses the apparatus needed to quadruple in value or more by 2030. Investors were puzzled as to why marijuana stocks have gone up in a cloud of smoke during the past 7 months. We can see by the disappointment based on the setbacks in Congress, not making any progress in cannabis reforms. Despite this, 36 states have legalized cannabis in some scope. Jushi and its esteemed peers possesses more than enough opportunity to prosper without federal response. Jushi is an intriguing pot stock for its 3 state targets: Pennsylvania, Illinois, and Virginia. Every one of these states show $1 billion sales potential with their limited license markets. Pennsylvania and Illinois actively cap the quantity of retail licenses in total that they will have to issue for a single business, while Virginia jurisdiction is the qualifier by which they allot licenses. Currently, with only 24 operating dispensaries, Jushi is pursuing high-dollar markets where regulators are purposefully dominating a competition. This is the method by which they can develop their brands and a dedicated base of customers without being drawn in by an MSO with more working capital. It is good to highlight that $45 million of the initial $250 million raised by the company was due to executives and insiders. This always equals a positive where there is a harmony between the interests of the executives and insiders when it aligns with shareholders. Number 3. EverQuote. Insurance is probably not what you initially imagine as an exciting industry. Down 66% from its 52-week high and remained a beaten-down online insurance marketplace, EverQuote is dedicated to making shopping for insurance as much of a hassle-free option available to its consumers and clients. EverQuote determined that the US insurance distribution and ad market should see a growth of 4% annually and on through 2024. In the interim, digital insurance ads are noted to move up by 16% annually during the timeframe. EverQuote operates only in this digital realm. The bulk of the company's revenue is derived from its auto insurance marketplace, which is partnered alongside 19 of the 20 largest auto insurers. Consumers have the power to price compare policies expeditiously and make a purchase through its marketplace. It is estimated that about 1 out of 5 users with a quote obtained on their platform follow through with their purchase of a policy. The area of focus here is their choice that with insurers throwing ad dollars at a wide and potentially unqualified audience, highly motivated consumers will be furnished by EverQuote, who will provide them with more results for their advertising dollar. As a bonus, EverQuote is advancing into new insurance verticals. In addition to auto insurance, EverQuote can also present consumers with commercial, health, life, home, and renters insurance. With these newer verticals that represent a smaller chunk of total sales, they're growing much faster than the auto marketplace, which plays a key role in pushing EverQuote's valuation way up. Number 4. Root. Here's another leading edge in small cap growth stocks with the power to turn a $200,000 investment into $1 million at the turn of the decade. And it's an insurance company called Root. Down 82% from its 52-week high, and even though it lost more than 80% of its value since debuting its IPO, Root's special formula for providing pricing for insurance policies could quite possibly be an innovation in and of itself. Traditional insurance companies for auto use very broad metrics when pricing their policies, by including credit score and marital status. Regrettably, those metrics don't provide insurers with a vital piece of info. Is this consumer a satisfactory driver or not? In this case, Root leans on still bargaining telematics technology to establish the price of its auto policies. It banks on the remarkably sensitive instrumentation within smartphones, such as the accelerometer and a gyroscope, to comprehend the turning, braking, and acceleration to G-forces. Basically, Root has more precise data to price policies based on how the customer drives prior to even buying a policy. In actuality, this new technology still operates as a work in progress. From the beginning, it produced a lower than expected direct accident period loss ratio during Q1 of 2021, but doubled back in the Q2 that followed. Even so, this loss ratio has consistently been below 100% since the Q1 of 2020, testifying to the fact that Root can write profitable policies. Even with investors staring down sizable short-term losses while the company cranks its digital marketing campaign, Root's unprecedented approach could very well turn this company into a big win by 2030. Number 5. Pubmatic. Last but never least, regardless of it being down 66% from a 52-week high, small-cap advertising tech stock Pubmatic shows that turning $200,000 into $1 million or more by 2030 is a reasonable expectation. In case you missed the prevalent trend outlined in our discussion of EverQuote, allow us to repeat that advertising is only headed one way, and that's digital. It is highly unlikely billboard or print ads will vanish, but it is more efficient than ever to broadcast to users online. This is the space that Pubmatic has a foothold in. Essentially, Pubmatic is a sell-side programmatic ad platform that uses the algorithms of machine learning to optimize relevance placement of ads for its clients. In layman's terms, Pubmatic represents publishers looking to sell their valuable display space. Optimized ad placement for users, keeping readers and advertisers happy, and tends to lift display pricing power for the company's publishers. We see that it's working, with the existing publishers spending 50% more at the end of Q2 than they did in Q2 2020. Furthermore, this is still the relatively early stages of this digital movement, but as Pubmatic's data seems to reflect industry-wide yearly digital ad sales that have a growth of 10% right through 2025, Pubmatic remains consistent in doubling up growth rate in the industry. Pubmatic's growth should center around TV and outrageous programmatic ads, which is one of the fastest growth niches within the digital ad arena. Well, that's it for today. What do you think about our picks? Share your own in the comments below. Make sure to subscribe, like, and hit that closing bell for notifications.